Hello everyone, I'm Hassan. Today I'll be revisiting the autumn budget. I'll also be discussing why we should be optimistic about the UK's outlook in 2026 and beyond. It's been around 2 months since the budget was announced. We've all shared our grievances and talked about income tax thresholds, manifestos, as well as several other issues that gets everyone worked up. Of course, I'm here to focus on the finance side of things and provide you with some positive takeaways from the budget, and more importantly, discuss how everything is going to affect your income, your business, and your investments. The main priority that Rachel Reeves had in the lead up to the budget was to stabilise bond markets. Since 2022, the UK has been suffering from a lack of credibility and confidence due to us having several prime ministers within a short space of time. In that same period, we had the disastrous Liz Truss budget, which saw bond yields almost double and rising around 200 basis points. Bond yields are not only reflective of the cost of government borrowing, but it's also an indicator that used throughout the economy when it comes to lending rates, general market sentiment, as well as the cross-border capital flows. Following the announcement of the budget, there was an almost 20 basis point drop in the 10-year government bond yield. That reflects positive reception by the market to the announcement and growing confidence in the policies that have been set, and more importantly, the people that have set the policy. We even had Jamie Dimon himself, the JP Morgan CEO, come out in support of the budget, stating that it's fiscally disciplined as it allows the UK to increase its revenues without stifling growth. That was, of course, on the eve of him announcing JP Morgan's brand new EMEA headquarters, which will be based here in Canary Wharf in London, and is a 7-year, £3 billion project. This is interesting because it's a completely opposite stance to what was portrayed in the media. We've all seen the doom and gloom from various media outlets, whether it's mainstream, social media, as well as all the supposedly unbiased experts. As stated previously, we will have several reasons to be dissatisfied with this budget. From a personal point of view, having been in the real estate business for 13, coming up to 14 years now, I'm not very happy about the increased taxation to rental income, to dividends, the introduction of mansion tax, second home council tax premiums, and the many other taxes and rule changes that we have faced since 2014 in our industry. But we do have to take out the personal aspect when we do look at such high level of policy and decision making in order to fully understand the impact that it will have on us moving forward. Going back to what I said earlier, the main objective for Rachel Reeves and the Labour government was to provide some stability to bond markets and boost the confidence and regain some credibility with the current bondholders and bond investors. This will in turn reduce government bond yields and allow the government to borrow more for less and make future spending more affordable. This will provide us with more stability when it comes to future budgets and future tax policy, as we can assume due to the government's improved affordability, improved capability when it comes to servicing its debts. We won't be seeing any tax changes or tax increases for that matter. So as there has been marginal increases in taxation, there has been also improved level of disposable income. As we have seen in the mortgage market, we can get a 2-year 75% loan to value product at around 365 to 3.75, which is significantly lower than it was a year or even 6 months ago. Moving away from the budget fallout, I want to get into why I'm optimistic about the UK's outlook in 2026 and the years to come. First and foremost, I want to talk about the unlocked value in UK companies. In 2025, we saw the FTSE outpace the S&P. That was largely due to investors moving away from the volatile US market and moving into the UK, where it's a more stable environment and benefits from dividend cash flow. In the same year, we had $142 billion worth of transactions where an overseas investor acquired a stake on an entire UK business. We had deals such as DoorDash acquiring Deliveroo for $2.9 billion, and on the private equity side, for example, we had KKR acquiring Spectrus, And this was a 74% increase from the previous year. And this level of activity is expected to continue in 2026 and 2027, largely due to UK companies being seen as undervalued when compared to their US and European counterparts. We've also seen some of the world's most renowned angel investors and founders invest and acquire stakes in UK startups. For example, we had Mark Benioff, who's the Salesforce founder and CEO, acquire a stake in Fixer AI. And we also had Patrick Collison acquire stakes in Riven Industries and Solve Intelligence. This is really a testament to the UK as a global talent hub and a show of its talent density due to us having 4 of the top 10 universities in the world at home. The second reason why I'm so optimistic is due to the opportunities we currently have in the property market. We've seen the headlines and the data regarding the northern regions of the UK outpacing the rest of the country when it comes to house price growth. More importantly, the north outpacing London, which is very much stagnating currently. The north has experienced such growth due to their major cities, Leeds, Liverpool, Manchester and the like, outpacing the rest of the country when it comes to job creation and really cementing themselves as an employment hub. It's also largely due to real estate investors moving their capital to the north as they seek lower stamp duty liability due to the lower price points for properties in the north, but also as they seek opportunities for higher yields due to a lower supply of professionally managed good quality rental accommodation. Going back to London's property market, I'm never comfortable throwing a blanket rate on such a large area. More importantly, an area that has extreme discrepancies when it comes to quality of accommodation, income levels, access to amenities and price per square foot. So we do need to dig deeper into the data. Remember, London is zones 1 to 6. And the main culprit when it comes to prices dropping is zone 1 or central London. Mainly prime central London, which I believe the technical definition is prices above 5 million. Or that's where I've seen most of the discounts that everyone seems to be talking about. But we do need to take into account how many properties were sold at a loss due to the sharp increase in service charges over the past couple of years. How many were sold at a loss due to councils and management companies cracking down and enforcing Airbnb, short-term rentals and subletting in general. And how many were affected or sold at a loss due to the government banishing non-dom tax status. You have to now look at London in its entirety. The days of simply focusing on buying a property as close to central London as possible and letting the rental income cover interest and maintenance cost and making money after 5 to 10 years of holding it automatically is no longer a reality. You have to put way more analysis and work into that because transport links have allowed renters and occupiers to look afield and giving them the opportunity to prioritize more internal space, better outdoor spaces and all the other different preferences that have changed in the past 10-15 years. Now more than ever, it's important to understand each area at a micro level. From me personally speaking, I sort of dig into an area and try and understand even street by street because a lot of the time, if a property is generating this much income or going at such a price, does not mean that it's the same 2 roads down, and you have to understand why. You have to understand the style of the property, who are the other owners and occupants there. It comes to really down to that level of detail in order to make your investment work. Because remember, it's not about simply finding a tenant. You have to find the right profile of tenant at the right rental income in order to justify your investment. The third reason to be optimistic is due to the growing conflict throughout the world. The UK's stable economical, political and legal landscape will continue to be of huge demand when it comes to new and existing industries. They will continue to seek stable markets to collaborate, to expand, and more importantly, establish regulatory and legal frameworks for their goods and services. We've recently seen Baidu, which is based in Beijing, and Waymo, which is based in San Fran, both select London as their first international city of expansion to roll out their robo-taxis. Testing of their taxis have commenced, with full operation expected towards the latter parts of 2026. This will cause a huge increase in demand for the UK's facilitation, advisory and support services. We've seen several law firm, wealth management firms and investment management firms increase their office space in the City of London. We've also seen a huge increase in the activity of poaching staff from one another within those industries. Before I finish the video, you might think to yourself, why do I care if a pension fund finds UK government bonds more attractive now? Why should I care if DoorDash is acquiring Deliveroo for 2.9 billion? You have to look at it from this way. Whenever there's a huge amount of capital being deployed by these institutes, there's a huge amount of due diligence, huge amount of reasoning and identification of an opportunity to create value. So you can use that reasoning in order to tailor it to your level of investing, to your level of operation. For example, Blackstone acquiring a block of 500 flats in Norwich, for example, and they acquired it for 30 or 40 million pounds or whatever the number is. Obviously, you're not going to go up against Blackstone in that deal, but you can use Blackstone's marketing when it comes to that neighborhood or that development, and you can buy properties in the surrounding areas, 1 unit, 2 units, whatever you can afford, and benefit from the new community that will be moving there. They might offer furnished rentals, you offer unfurnished, or you offer furnished as well. So there's huge benefit that comes from being the little guy, and you can be nimble enough to buy 1 or 2 units. Because Blackstone, they need it to be 300, 400, 500 or 1,000 units in order to make it work for their investment parameters. Just something for you to think about and apply to your daily thinking and into your investment strategy. Thank you for watching. See you next time.